For decades. I mean, for as long as any of us have been investing, global finance has operated on this one core assumption.
This non-negotiable belief, really.
Exactly. That the U.S. Treasury bond is the ultimate risk-free asset. It's the bedrock, the foundation for everything. Zero default risk, guaranteed.
It's the starting point for pricing every other asset in the world. The entire $28 trillion system is built on it.
Okay, so hold that image of an unshakable foundation. Because here's the truly shocking paradox we've seen. The 2022-2023 Treasury bond crash was, and this isn't an exaggeration, the worst government bond rout in 270 years of financial history.
It sounds like hyperbole, but the data is just relentless. From the peak in 2020 to the bottom in 2023, long-term treasuries plunged a staggering 53%.
53%?
Yeah, think about that for a second. You buy the safest asset on planet Earth, and you lose half your money. That's a loss that's, right up there with the 2008 stock market crash or the dot-com bust.
And yet, and this is the crazy part, most people have no idea this even happened. This historic collapse was hidden behind, technical jargon and accounting rules.
Pretty much.
So our mission today is clear. We're going to dive deep into the sources and figure out what happens when that foundation cracks. We're going to expose the mathematical lie at the heart of that risk-free label. Okay, let's unpack this.
We have to start with the sheer scale of the destruction.
Yeah.
The numbers are, they're genuinely historic. Let's just look at 2022 alone.
Okay.
The 30-year Treasury bond lost 39.2% of its value in 1 year.
39.2%. I just have to say that again because it's a number that almost doesn't make sense. Put that into some context for us.
Well, that single-year loss was worse than what bondholders suffered during the American Civil War.
Wow.
Worse than during 2 world wars, and even worse than the famous Volcker shock in the 1980s. You literally have to go back to 1754, before the United States was even a country, to find a year that bad for government debt.
Unbelievable. And what if you were just a regular investor trying to be safe with that classic 60-40 stock and bond portfolio?
That portfolio had its worst year since 1937.
1937, the middle of the Great Depression.
Exactly. The bonds, which are supposed to be the ballast, the anchor that keeps the ship steady when stocks go down.
Right, the head.
They actually compounded the losses.
Right.
The safe harbor was the thing that sank the ship.
So what was the trigger? We know the immediate cause was the Fed.
It was the fastest rate shock in 40 years. The Fed finally woke up to inflation not being transitory and just slammed on the brakes.
They raised the Fed funds rate by 525 basis points, from basically 0 up to 5.5%.
All in just 16 months, starting in March 2022.
That's a tectonic shift. But explain why that caused such a violent price collapse. I mean, we know rates go up, bond prices go down. It's simple math. But to lose half your value...
This is where the mathematical reality of duration becomes absolutely brutal.
So duration is the key word here.
It's the entire story. Duration is just a measure of a bond sensitivity to interest rates. A simple way to think about it is how long you've locked your money away for. The longer the time, the more extreme the price swing when rates move.
And for long bonds, that sensitivity is huge.
It's immense. A 30-year Treasury has a duration of about 20 years. And the rule of thumb is painful. For every 1% that interest rates rise, that bond's price will fall by about 20%.
20%. So you do the math. Rates went up over 3%. A 40% loss wasn't a surprise crash.
It was a mathematical certainty. It was programmed into the bond itself.
And what's crucial here is the context. I mean, we saw Paul Volcker jack up rates in the 80s, but it didn't cause this kind of systemic meltdown.
Right, because the debt landscape was completely different. When Volcker raised rates, the U.S. debt to GDP ratio was about 31%.
Manageable.
Very. When Jerome Powell raised rates in 2022, debt to GDP was over 120%. More debt plus higher rates equals exponentially larger losses. The entire system is just far, far more fragile.
So that's the how. That's the math. Now we need to get into the why. Why were trillions of dollars of this high-duration risk allowed to build up in the first place? This brings us to the regulatory illusion.
Exactly. That term, risk-free, only refers to one thing in finance: credit risk. The idea that the U.S. government won't default.
But it completely ignores all the other risks.
It ignores interest rate risk, duration risk, inflation risk, and liquidity risk.
Yeah.
All the things that actually blew up the system.
So it's an incomplete definition that was basically baked into the global rulebook.
Absolutely. Under the Basel capital requirements, the rules for banks' treasury bonds get a zero risk weight. And this is the key.
A zero risk weight. Meaning what, exactly?
It means a bank can hold trillions of dollars in these long-duration bonds and not set aside a single penny of capital to protect against price losses from rising rates.
And here's where it gets really, really interesting. The sources we looked at show this wasn't an accident. This crisis was basically designed decades ago.
It was. Back in 1988, when they were writing the first Basel rules, regulators actually proposed a positive risk weight for long-term treasuries. They saw this exact danger.
So what happened?
The banking lobby pushed back hard. They argued that holding capital against sovereign debt was too restrictive, so the regulators just dropped it.
They created a massive subsidy for banks to load up on the riskiest type of government bond.
They encouraged the very behavior that caused the crisis. It was a ticking time bomb.
And there was another layer to this, an accounting trick that hid the bomb from everyone.
We're talking about the difference between available for sale, AFS, and held to maturity, or HTM securities.
Okay, so AFS means you have to market to market. The losses show up immediately.
Right, it hits your capital right away.
Right.
But with HTM securities, you carry them at the price you paid for them.
The book value.
The book's value. And as long as you can just tell the regulator you intend to hold that 30-year bond for 30 years, you get to ignore the market price collapse completely.
Which created this concept of sedentary insolvency.
That's the perfect term for it. A bank could be solvent on its books, but completely bankrupt in reality, just hoping they'd never be forced to sell.
And we have to remind everyone, this isn't just numbers on a screen. The Treasury market is the plumbing of the entire financial world.
It underpins over $1 trillion a day in the repo market. It's the collateral for derivatives. It's what foreign central banks hold as reserves.
So when the value of that core collateral plunges, the entire system can just freeze.
The collateral chains can snap. And that's exactly what started to happen.
The consequences weren't theoretical. We saw immediate, high-profile casualties. And the first big one, the definitive symptom, was Silicon Valley Bank, SVB.
SVB was the textbook case. During the pandemic tech boom, their deposits just exploded. They had all this cash, and they did the regulator-approved thing.
Right. They bought safe, long-duration treasuries yielding, what, less than 2%?
A paltry 1.79%. They did what they were told was safe. And the moment rates rose, that duration risk just destroyed them.
By how much?
By early 2023, SVB was sitting on $17.7 billion in unrealized losses. And here is the single most jaw-dropping stat of this whole crisis.
Okay.
That $17.7 billion in hidden losses was 110% of the bank's total capital.
110%. So on a mark-to-market basis, they were already completely wiped out.
Functionally bankrupt.
Yeah.
But the HTM accounting hid it. Until, of course, their tech depositors started pulling their money out.
And they were forced to sell.
They had to sell part of that underwater portfolio, which forced them to finally realize the loss. That triggered the panic, and $42 billion was pulled from the bank in a single day.
The second largest bank failure in U.S. history. Killed by the safest asset in the world.
But this wasn't just a U.S. problem. The exact same dynamic duration risk plus leverage nearly took down the entire U.K. pension system just a few months earlier.
Right. The gilt crisis in September 2022. That one started with politics, with the new Prime Minister, Liz Truss.
Yes. Her mini-budget of unfunded tax cuts. The bond market just revolted. 30-year gilt yield spiked by a full percentage point in a couple of days.
The bond market is the ultimate HR department, isn't it? She was effectively fired 44 days later.
But the fragility was already there. UK pension funds were using these heavily leveraged strategies called liability-driven investment, LDI.
Using gilts as collateral.
Often with 3x leverage. So when gilt prices crashed, they faced massive instant margin calls.
And that created the classic doom loop.
The death spiral. They had to sell gilts to meet the margin calls, which pushed gilt prices down even further, which triggered more margin calls.
Forcing more selling, a self-reinforcing fire sale.
It nearly collapsed the entire £1.7 trillion UK pension system. We were literally hours away from widespread insolvency.
Until the Bank of England stepped in.
They were forced to. A $65 billion emergency bond buying program to stop the bleeding. It just showed how systemically dangerous this hidden duration risk had become.
Okay, so here we are now. Those were the acute crises of 22 and 23. Is the danger over? Has the system fixed itself?
Not even close. The sources are very clear on this. As of late 2024, U.S. banks are still sitting on a stunning $482 billion in unrealized securities losses.
$500 billion. So the time bomb is still there, just sitting on their balance sheets.
It's a massive anchor on the entire system. It limits their ability to absorb any other shocks, like, say, commercial real estate defaults. If another crisis forces them to sell those underwater bonds.
That $500 billion loss becomes real instantly.
And this brings us right to the bigger picture, to this idea of financial dominance. The Fed is now in an impossible position.
An impossible choice between its two mandates, right? Fight inflation with high rates or maintain financial stability with low rates.
Precisely. They are constrained from fighting inflation too hard, because every rate hike deepens those bank losses and makes the government's own debt payments skyrocket. The system is too fragile for the medicine.
And their actions proved it. The creation of the Bank Term Funding Program, the BTFP, in March 2023.
That was the ultimate stealth bailout. It let banks borrow against their underwater treasuries at par value, at the original price, ignoring the crash.
So the Fed basically said, we will pretend your assets aren't worthless to keep the system afloat.
It was a signal that the risk-free asset now needs an explicit central bank guarantee just to function.
So how is the rest of the world seeing this? Foreign central banks, they must be watching this instability with a lot of concern.
Oh, they are. The Treasury crash has absolutely accelerated the de-dollarization trend. Stable, long-term buyers like China have been steadily reducing their holdings. China is now at its lowest level since 2008.
So if the stable buyers are leaving, who is buying all the new debt the U.S. is issuing?
Increasingly, it's leveraged hedge funds, often doing complex basis trades. These are short-term, opportunistic players. They're the exact opposite of stable demand. And that just adds another layer of fragility to the whole system.
So what does this all mean? When you put it all together, the mathematical certainty of the crash just invalidated the entire regulatory assumption that these bonds are safe. The foundation was built on a lie.
It was the lie of zero interest rate risk. And now that foundation has cracked wide open. The data says it all. The risk-free asset just had its worst crash in 270 years.
So the question isn't whether it happened.
No, the question is whether the building can still stand with $500 billion in losses still sitting in the basement, just waiting for the next tremor.
And you can see the world reacting to that cracked foundation. If the ultimate safe asset is broken, what are global central banks buying as a hedge?
Gold. Record amounts of gold. China has reported 18 straight months of gold purchases.
So why is gold, an asset that pays zero yield, suddenly the preferred insurance policy against a broken bond market?
Well, that sounds like a topic for our next deep dive.